Well, joining me now with more and what this means for the stock market and your money is Jay Woods, Chief Global Strategist at Freedom Capital Markets. Jay, it's great to have you on the show here. So much to digest.
A lot going on.
And let's kick it off with what this week of September means.
Yeah, September historically has been the most volatile month of the year. If you go back to 1928, it's the only month of the year that is not up on average. It's down by an average of 1%. And what happened? First day of September, after a nice run at the end of August, we had a little bit of a sell-off. Worst day since just August 5th of last month, but it caused a little jitters. We'll see if it continues. But the good news is that slump was led mostly by technology, and there were some great pockets of strength throughout the market.
We look at the data so closely here at the stock exchange, and of course, as part of the stock exchange's parent company, I know you are looking at the data as well. The volume that we've seen, does it seem like there is conviction behind these trades, that people really are back maybe from summer break?
Yeah, I don't think we're back yet. There was a little more volume, but nothing overwhelming. When you have a downdraft like we had yesterday, a 2% correction in the S&P 500, you want to see how serious it is, and you look at the volume metrics. The VIX did spike back up above 20. That is the highest reading we've seen since that August 5th surge. But there's no real panic in this market right now. Some jitters, yes, but this is normal September shenanigans, as I like to say, and I expect volatility to be here, probably until the election is over.
It's interesting. For so long, we had heard from the Fed that inflation was almost its only focus, its sole focus for years when it came to lowering interest rates. But at its latest meeting in July, it certainly changed its tune, and jobs now finally became in focus. With the jobs data this week, what is your expectation in terms of what that will mean for Americans and how the Fed might respond in mid-September?
Yeah, the Fed always talks about a dual mandate, but they've been so focused on the inflationary numbers, getting those back down to their 2% goal, that we kind of lost sight of unemployment. Unemployment still at historically low levels, but what we saw last month with the July numbers was an unexpected spike from 4.1 to 4.3. That caught people off guard. It happened 2 days after the Fed meeting, so the Fed clearly didn't know those numbers were coming, or maybe they could have had that cut. So now what it tells us, okay, unemployment could become a problem. It's trending in the wrong direction. So let's see what happens. This Friday number of 4.2% is going to be looked under and scrutinized like no other number we've had in a while. If it comes in hotter, above 4.2%, then yeah, we could see another little bit of a sell-off here, and then we'll talk about how much will the Fed cut. We expect a 25 basis point cut. Powell pivoted when he went to his Jackson Hole meeting, so that isn't a surprise. But if unemployment ticks up a little higher than expected, we could be talking a 50 basis point cut and get a little more fear in this market, which would not be welcome.
How does the economy feel to you right now?
The economy is running on all cylinders. Earnings growth continues to be rather consistent. We're seeing some of the small cap companies start to grow at a pace that we haven't seen in the last 2 years. The biggest stocks, while beating, they're not guiding with the great oomph that we were hoping for, and that's what caused some of the tech stocks to pull back a little bit. And then they also got a little too far out over their skis. So you see this when stocks go up, 50, 100, 150%, there will be some pullbacks. What I like is the rotation, and you see 6, 7 sectors, industrials, financials, materials, hello Eastman, making new highs. This is positive. So there's rotation under the surface, but those big market cap heavy-weighted stocks are pulling back right now, and it's taking the bigger indexes with them for the ride.
So let's talk about that, because these large technology names have such an outsized impact. What does this mean for smaller companies like an Eastman Chemical that we'll hear from momentarily?
Yeah, well, what we're seeing, we're not seeing money rush for the exits. We're seeing money rotate into stocks that have underperformed. Now, Eastman's up 11% for the year. The XLB, the material index, is up 8.6%. It's underperforming the S&P 500, but it's outperforming its peers. And right now, Eastman's in a nice neutral range. And what we're seeing are a lot of these stocks that have been going sideways, say since March, starting to break out, and that, as a technician, I like to see. So while there are headlines being made in the big tech stocks, those magnificent seven, if you will, under the surface, we're seeing market breadth expand. We've seen a few sectors like healthcare and financials get a little too far out over their skis. They can pull back these are healthy, normal retracements in secular bull markets. So while the headlines in September may cause some angst, I think the long-term trends and the setups are there for smaller cap, mid-cap companies to really finish the year strong.
Jay, always a pleasure. Thank you so much for joining us in studio. We'll